to the Masters Advisors Financial Foundations webinar series, where we cover a wide range of financial topics, including cash flow management, investments, risk management, and taxes. Today, we're going to talk about taxes. My name is John, and I serve as an advisor on the team here at Masters. So the first thing we're going to talk about are some just high-level basics on our current federal tax system. This slide is helpful to put our current tax system in context. The top chart shows the highest marginal income tax rate over the past 100 years, from 1925 to when our current tax law sunsets in the year 2025. And as you'll notice, the current years that we're in are in purple on the right-hand side, and you'll notice that our current tax system, we are at a relatively low tax point. When you look at recent history. The average person believes that our taxes are constantly increasing at the individual level. And while certainly people have seen increases in taxes, when you stretch your perspective out to the last 100 years, our current tax system is actually at a relatively low point, especially at the highest marginal rate. I thought it would be helpful to include this slide, which shows the 2023 tax brackets. And the left-hand column is for those that file a single tax return. Middle column is for those that file married, filing jointly. And the right-hand column is for those that file as head of household. And our current tax system is a progressive tax system. That means our tax system works kind of like a bucket of water. First, for a single person, $11,000 of taxable income will be taxed at a 10% rate. Once you exceed $11,000 of taxable income in 2023, the excess spills over into the 12% tax bracket, and you will pay a 12% tax rate on the income that you earn between $11,000 and $44,725. Once you exceed $44,700, the excess spills into 22%, so on and so forth. So it kind of works like a bucket of water. The water fills up the lower buckets first, and once theirs are exceeded, it spills into the higher buckets. Same goes for our tax system. A couple of things here on taxes. First, I thought it'd be helpful to highlight the differences between a tax deduction and a tax credit. A tax deduction is a reduction in your taxable income. An example of a tax deduction would be pre-tax 401k or IRA retirement savings. And these tax deductions are phased out for higher income taxpayers. Also, most folks are able to pick between the standard deduction and an itemized deduction. For IRS data as of 2020, over 87% of individual taxpayers chose the standard deduction. You can pick the higher of the two. The standard deduction amounts do vary based on filing status and on a couple of other factors, age and other sorts of things. And you can see the different tax deduction amounts for 2023 on the screen. There are tax credits as well. Tax credits are a dollar-for-dollar reduction in the tax owed, and they have a greater impact on your tax liability than a tax deduction will. There are two different types of tax credits, refundable tax credits and non-refundable tax credits. A non-refundable tax credit will only be able to be used if you have a tax liability to offset. So for example, if you have a $5,000 tax liability and a $6,000 non-refundable tax credit, the extra $1,000 will not be able to be received by you. They will be lost. A refundable tax credit is able to be refunded if you don't have all the tax liability to use it. So in my example, $5,000 tax liability, $6,000 refundable tax credit. The extra $1,000 in my example could be able to be refunded to you on your tax return. The next section we'll talk about are tax items to watch. For W-2 employees, those that receive a paycheck, You want to be aware of your tax withholding amount. If you typically receive a large refund when you file your taxes every year, be aware of the fact that you're giving a free loan to the federal government. What you can do instead is adjust your withholding to get closer to break even, or where you get a smaller refund amount. And instead then you get to use your money throughout the year for other savings or investing or spending goals that you have for yourself, instead of giving the government a free loan. However, be aware of the opposite, which is if you are not withholding enough and you're underpaid in federal taxes, you are exposing yourself to the chance of having penalties assessed. So you do want to make sure you work with a qualified tax professional to make sure that your withholding is appropriate for your individual tax situation. You also want to keep an eye on your adjusted gross income. The adjusted gross income is your gross wages minus certain deductions. And AGI, as it's been abbreviated, is used by many government agencies to determine eligibility for different programs, incentives, tax credits, and tax deductions. So you want to make sure you're managing your AGI amount so that you can leverage the incentives and benefits that our tax system has built in. Final point here on taxes. If you find yourself in a unusually high or low tax year, before the year is out, consult with a tax professional and inform them as to your current tax situation relative to your normal years. And they may be able to help you understand some options you can take before the year is over to take advantage of that tax situation. That concludes our webinar on taxes. Stay tuned for our other presentations on cash flow, investments, and risk management. Thank you.